Albert Einstein supposedly called it the eighth wonder of the world. Warren Buffett built his $100 billion fortune with it, and it's the reason why a 25-year-old investing $300 a month can retire a millionaire, while a 45-year-old investing $1,000 a month might not. I'm talking about compound interest, the most powerful wealth-building force on the planet. Today, I'm going to show you exactly how it works, why starting early changes everything, and how you can use it to build serious wealth even if you're starting with almost nothing. Let's dive in. Here's the thing about compound interest that blows people's minds. It doesn't just grow your money, it grows your growth. That sounds confusing, I know. But by the end of this video, you'll understand exactly what that means. And more importantly, you'll see why the decisions you make today about money will matter way more than you think. Because here's the secret that wealthy people understand and broke people don't. Time is more valuable than money when it comes to building wealth. A person who starts investing at 25 will end up richer than someone who starts at 35, even if the 35-year-old invests twice as much money. I'm going to prove this to you with real numbers. But first, let's break down what compound interest actually is. Compound interest is when you earn interest on your interest. Let me explain with a simple example. You invest $1,000 at 10% annual return. Year 1. You earn $100 in interest. Your balance is now $1,100. Now here's where it gets interesting. Year 2. You don't just earn 10% on your original $1,000. You earn 10% on the full $1,100. That's $110. Your balance is now $1,210. Year 3. You earn 10% on $1,210. That's $121. Your balance is now $1,331. See what's happening? Each year you're earning returns not just on your original investment, but on all the growth that came before. Your money is making money, and then that money is making money. This is different from simple interest, where you'd only earn $100 every single year on that original $1,000. With simple interest, after 10 years, you'd have $2,000. With compound interest, after 10 years, you'd have $2,594. After 20 years, simple interest gets you $3,000. Compound interest gets you $6,727. After 30 years, simple interest, $4,000. Compound interest, $17,449. Same starting amount. Same interest rate. Massive difference in results, and that's with just a one-time investment. Now imagine you're adding money every single month. That's when things get really crazy. Let's look at a realistic scenario. You're 25 years old. You start investing $300 per month in a stock market index fund that averages 10% annual returns. Let me show you what happens. After 10 years, age 35, you've contributed $36,000. Your account balance, $61,453 you've made, $25,453 in growth. Not bad, right? But watch what happens next. After 20 years, age 45, you've contributed $72,000. Your account balance, $227,933 you've made, $155,933 in growth. Now you've made more in growth than you put in, but we're just getting started. After 30 years, age 55, you've contributed $108,000. Your account balance, $678,146 you've made, $570,146 in growth. After 40 years, age 65, you've contributed $144,000. Your account balance, $1,897,224 you've made, $1,753,224 in growth. Let me say that again. You put in $144,000 over 40 years. That money grew to almost $1.9 million. That's the power of compound interest. You contributed less than $150,000, but compound growth added over $1.7 million to your account. Now, here's the part that really matters. Look at the last 10 years alone. From age 55 to 65, your account went from $678,000 to $1,897,000. That's over $1.2 million in growth in just the final decade. Why? Because by that point, you had so much money in the account that even though you were only adding $300 a month, the compound growth on the existing balance was massive. This is what Einstein meant. This is the eighth wonder of the world. Now, let me show you why time is more important than money when it comes to compound interest. Let's compare two people. Early Emma starts investing at 25. She invests $300 per month for 10 years, then stops completely. She never adds another dollar after age 35. Late Larry waits until 35 to start investing. He invests $300 per month for 30 years straight until age 65. Both earn 10% annual returns. Who do you think ends up with more money at age 65? Early Emma contributed $36,000, only 10 years of contributions. Balance at 65, $1,589,733. Late Larry contributed $108,000, 30 years of contributions. Balance at 65, $678,146. Wait, what? Emma contributed $36,000 and ended up with $1.59 million. Larry contributed $108,000 and ended up with $678,000. Emma put in less money but ended up with more than double what Larry has. Why? Because she started 10 years earlier. Those extra 10 years gave her money more time to compound. Even though she stopped contributing at 35, her account kept growing on autopilot. This is the most important lesson about compound interest. Starting early beats contributing more. 10 years of investing in your 20s is worth more than 30 years of investing starting in your 30s. But it gets even crazier. Let's look at one more comparison. If Larry wanted to catch up to Emma's $1.59 million, he wouldn't need to invest $300 per month starting at 35. He'd need to invest $700 per month. More than double what Emma invested just to make up for those 10 lost years. This is why every year you wait to start investing costs you so much. You can't get time back. And with compound interest, time is everything. Here's a simple trick to understand how fast your money will grow. The rule of 72. Divide 72 by your interest rate, and you'll know how many years it takes for your money to double. Examples. At 6% returns, 72 divided by 6 equals 12 years to double your money. At 8% returns, 72 divided by 8 equals 9 years to double your money. At 10% returns, 72 divided by 10 equals 7.2 years to double your money. Let's see what this means in practice. If you invest $10,000 at age 25 and earn 10% annually, here's when your money doubles. Age 32, $20,000. Age 39, $40,000. Age 46, $80,000. Age 53, $160,000. Age 60, $320,000. That original $10,000 became $320,000 by age 60. Just by sitting there and compounding, you didn't add a single dollar after that initial investment. This is why wealthy people say, pay yourself first. Because every dollar you invest early has the potential to become $10, $20, or even $30 by the time you retire. But every dollar you spend on stuff you don't need is a dollar that could have been working for you for decades. Now that you understand how compound interest works, let's talk about where you can use it. Stock market investments. This is the big one. Index funds like the S&P 500 have averaged about 10% annual returns over the long term. This is where most people build wealth through compound interest. Invest in index funds through a Roth IRA, 401k, or regular brokerage account. Set up automatic monthly contributions. Let it compound for decades, high-yield savings accounts. Not as powerful as stocks, but still uses compound interest. If you have an emergency fund and a high-yield savings account, earning 4 to 5%, that interest compounds monthly. Your emergency fund grows without you doing anything. Dividends. When you own dividend stocks and reinvest those dividends to buy more shares, you're using compound interest. Those new shares pay more dividends, which buy more shares, which pay more dividends. It snowballs. Real estate. When you own rental property and use the rental income to pay down the mortgage, that's a form of compound growth. Your equity builds faster and faster over time. Retirement accounts 401s, Ks, and IRAs are specifically designed for compound growth. The tax advantages make the compounding even more powerful. Plus, many employers match your 401k contributions. That's instant 50% or 100% returns before any compound growth even starts. The key with all of these is reinvest the returns. If you withdraw your gains or dividends and spend them, you break the compound effect. The magic only happens when you let your earnings stay invested and grow. Here's something most people don't think about. Compound interest works both ways. When you have debt, especially credit card debt, compound interest works against you. If you have $5,000 in credit card debt at 20% APR and only make minimum payments, here's what happens. Year 1, you owe $6,000. Year 2, you owe $7,200. Year 3, you owe $8,640. Year 5, you owe $12,441. That debt more than doubles in 5 years. Just like your investments can double, your debt can double too. This is why credit card companies are so profitable. They're using compound interest to make money off you. This is also why paying off high-interest debt should be your first priority before investing. Because if you're paying 20% interest on debt while earning 10% on investments, you're losing money overall. Get rid of the compound interest working against you. Then focus on the compound interest working for you. Let's bring it all together. Compound interest is the force that turns small, consistent contributions into life-changing wealth. The key lessons: 1. Start as early as possible. Time matters more than money. 2. Invest consistently. Even small amounts add up. 3. Reinvest your returns. Don't break the compound effect. 4. Be patient. The magic happens in decades, not months. 5. Avoid debt. Don't let compound interest work against you. Here's your action step for this week. If you're not investing yet, open a Roth IRA or start contributing to your 401k, even if it's just $50 a month. Just start. If you're already investing, run the numbers. Use a compound interest calculator to see where you'll be in 20, 30, or 40 years. It'll blow your mind and motivate you to keep going. The best time to start was 10 years ago. The second best time is today. If you found this helpful, hit that subscribe button and turn on notifications. Our next video breaks down exactly how to invest in index funds, step by step. Drop a comment and let me know. How old were you when you started investing? If you haven't started yet, what's holding you back? Thanks for watching, and I'll see you in the next one.
Before we start, I put together a free PDF called The Money Leaks Checklist, Anus Tamus 2025 edition. It breaks down the 10 biggest places people lose money without realizing it, and how you can plug those leaks today. If you want to stop wasting cash and redirect it into savings or investments, grab it free. The link is in the description and pinned comment. Download it now. It takes 10 seconds, and at Pollen Glancer persuasive. And it might be the most profitable thing you do today.